Okay, today's episode, we're going to be talking about vendor takebacks for apartment buildings in Ontario. So, for the last 6, 12, 18 months, I've really noticed an uptick in the number of sellers who are willing to offer vendor takebacks. In fact, four of the last five deals I've done have had vendor takebacks. Three apartment buildings, piece of land, ranging from about 3.4 up to 5.7 million. So, quite a broad swath. 2 years ago, we never would have seen that ratio. So it's really becoming quite a bit more favorable and popular with sellers, and for good reason. First of all, VTBs maximize the sale price, or they position you to maximize the sale price you're going to get. You make more money by taking the interest that would otherwise go to a bank. You get to potentially offset taxes. And most importantly, you are completely sidestepping risky finance clauses in your offer. Okay, so vendor takebacks, let's take a closer look. Let's start off by discussing exactly what a vendor takeback or VTB is. So, a VTB is when the seller turns into the bank for the buyer. It's as simple as that. The buyer's going to need a mortgage from someone, so why not you, the seller? So long as you, the seller, has a sizable down payment that will cover their costs if the buyer can't pay the mortgage, gets hit by a bus, runs the building into the ground. At worst, the seller ends up back with a property that they know well and that they trust. Let's talk now about the elements of a VTB. So, again, nothing strange about a VTB mortgage. Whether you are providing the buyer with a mortgage or the bank is, a VTB is still a mortgage. So, all the things that you would negotiate with your bank, you're going to negotiate with the buyer. So, things like the interest rate, what the term is, loan amount, down payment. Now, because you're the lender, you get to ask whatever you want, right? So there may be a few things that you want to get a handle on. So, for example, what position are you going to be in? So, position, as an aside, is the word that we use for the, let's call it the pecking order of who gets paid if a building goes into power of sale. We're going to avoid the power of sale and take some strategies to lessen the chances of that, but it does happen, right? So, taxes get paid first. First position mortgage gets paid second. Usually that's a bigger one. That would be from the bank. But you may be offering a second mortgage and you would be in third position. So, at any rate, that's what position is. You also want to get a good sense of the personal covenant of the buyer. So, what's their credit? What's their track record with other properties? If you've got some 27-year-old kid with no money who's never managed a building, that is a very poor candidate for a VTB. 55-year-old guy with 15 buildings that he runs successfully, that's an excellent candidate for a VTB. You also might want to have the right to inspect and monitor the building and the financials, right? So keep an eye on the building's income, expenses. That's what's paying you. If the plan is to reposition this building, what's the plan? What's the track record? Repositioning, by the way, is when somebody takes a building that may have some challenges, low rents, doesn't present nicely, and they position it with higher rents and a nicer hallways and paint job. That's repositioning. So if the VTB, the purpose of the VTB is to reposition the building. What's the plan? Where's the money coming from? Where have you done this elsewhere? Okay, so advantages. There are some real advantages for a seller choosing to offer a VTB. So these include number one, potentially getting a higher price. Again, you're positioning yourself to get a higher price. Let's imagine this scenario. Seller has got a 16 unit building that should trade for 250 a door or $4 million. Finds a buyer with $1 million or 25% down in cash. Buyer goes to their lender and says they want to buy this building but need a 75% loan to value. All right. So we're going to get a $3 million mortgage. I got $1 million. There's the financing. Now, other buildings of similar age and construction have traded at that 4 million, but this building, let's pretend it's got some long-term tenants that pay far below market rents. Maybe you've got numerous disputes with tenants and they're resisting eviction, and the building presents terribly. You haven't painted the hallways or done anything with the laundry room in 30 years. In this scenario, the building may appraise lower, Or the bank may feel that there is too much risk and only offer an effective mortgage for, say, 70% or 65. So not that 75 we're looking for. So 65, 70% of that 4 million. Or looked at another way, the bank only feels the building is worth 3.3 million or 2.8 million, and they are fine to lend, but based on those numbers. So this is a pretty clear demonstration of how a seller can use a VTB to get a higher price for a property that the market sees, the banks sees as challenging. Now, a caveat here is that the seller does not want to be tied to the property through the VTB forever. There needs to be an out at some point. Typically, what I see is a year to 5 years, with most around the 2 to 3 year mark. It's key, therefore, again, that the seller understands what the track record is of the buyer. What is their plan to move out those tenants that are dragging the value of the property down? The worse the tenant, the better, by the way, but that's for another video. Where is the money going to come from for the renovations and so forth? Another advantage, you make money as an investment. So, in addition to potentially making more money on the purchase, a seller can also take the money that would otherwise have gone to the bank. Let's take another look at that example above and assume that the seller and the buyer agreed to a VTB for 3 million bucks. Remember, he's got the million at an interest rate of 5% principal and interest, amortized over 25 years with monthly payments. Here we see that not only did the seller make more money on the purchase price, but also earned an extra 702,000 secured by an asset the seller knows intimately and trusts. A small aside here, in the above example, the buyer was paying back principal and interest, right? Often VTBs are interest only. Remember that in our example here, we have problem tenants who may not be paying rent and a number that are paying below market value. The whole plan here is to get revenues up enough over the course of the VTB to get regular financing from a regular lender. Again, why we want to know the buyer's track record and plan. So this repositioning is not something that happens overnight. So to give the buyer some wiggle room while they work out revenues, the VTBs are often interest only. So take a moment here. Look at the difference here between what rents need to be to support the VTB day one. Note as well that because all the VTB payments are interest only with nothing going to the principal, the seller actually will earn slightly more money at 750,000 up from the 702. Now, small thing, but of course, because none of the mortgage has been paid off, when the buyer does move to a traditional lender in year 6, they will have to qualify for modestly more, right? They didn't pay any of the $3 million down. Finally, offsetting taxes. Capital gains taxes are a consideration. They are. If you sell all at once, you get the money all at once. Taxes will soon follow all at once. If, however, you don't get the money all at once, you can spread things out. Now, I'm looking in the camera, so we are crystal clear. I am not an accountant, nor am I a lawyer. So if you're thinking about a VTB, and this is important to you, the tax deferral, talk to your professionals. But suffice to say, VTBs are done dozens of times a day, every day in Ontario, and tax deferral is one of the reasons why. Okay, so that in a nutshell is how VTBs work and why you, as a seller, may wish to consider offering one to qualified buyers. Again, you will position yourself for a higher price. You're going to make money off the interest, potentially offset taxes, and you are sidestepping the risk of a finance condition. So I hope you enjoyed this. And if you had stayed to the end here, please take a second to like the video and subscribe to the channel. It takes you 2 seconds and it really helps me out a lot. If you have any specific questions about your building, please feel free to reach out. I'd be more than happy to hear from you and have a quick chat. Thanks for watching, and we'll see you next time.